You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Welcome back, Brandon. How you doing?
Heyo.
Hey,
how's it going? I'm doing quite well because I'm sitting here in Glenelg. It's kind of funny. There was a couple of weeks ago we were saying, oh look, we hope to keep for every episode of the podcast now we want to do video as well on our YouTube channel. Yeah. And as soon as we said that, the next two episodes will not have video. But
yeah,
that's just the way it goes.
Promises.
No, yeah, exactly right, exactly. So yeah, I'm currently sitting in a hotel room with very dodgy internet, so I'm really hoping that the internet holds up. And of course, last week, very unfortunately, Andrew wasn't able to edit the podcast for us last week. So again, our thoughts are going out to you, Andrew. We hope you're doing all right over there in Ukraine, and fingers crossed that you and your family remain safe and sound. But yeah, geez, it's horrible what's going on over there, man. It's really been overwhelming me over the past week, just thinking about trying to follow what's going on. It's just a very sad situation, isn't it?
Yeah, it's terrible, and every day there's kind of something kind of new or developing that's happening, and it is. It's very sad, and hopefully all of the fighting will stop soon.
Please stop fighting.
Please stop it.
Yeah. That is the Young Investors Podcast message.
That's our slogan.
Our formal statement regarding the matter. Please stop fighting. Well, it's only one side that's fighting. One side's fighting. One side's just defending. Yeah,
pretty much.
So,
we've got a couple of things. I've actually got one story kind of related to the events that are unfolding, but related to finance, of course, that we'll talk about today around the Russian stock market. We've got the Buffett annual letter. That's always a good time of the year to break down what Mr. Warren Buffett has to say to the shareholders of Berkshire, but also pretty much just to the world of value investors. And I've got a little story on Foot Locker, which had a massive collapse this week. We've had a number of big collapses in stock prices over the past couple of weeks. We've had Netflix down 30%. We had Facebook down 30%. Foot Locker this week was down 30%. So
there you go.
We've got quite a bit to talk about. And I guess we'll just kind of get straight into it. So today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker, or you can do it manually one by one, or in your broker, you'll usually be able to download your trades into an Excel and then you can upload them to Sharesight. So it's basically automatic. And once you do that, it will track all of the different types of gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. So use that link, sign up to a free plan, and you can track up to 10 holdings for as long as you want. Or you can use that link to sign up to a paid plan for more features, and you'll get 4 months off a yearly subscription if you use our link. So go check it out. If you haven't already, what are you doing? Go check it out.
What are you doing? Check out Sharesight. Jeez, come on, man.
Did we just bully our audience into getting Sharesight?
Dear, oh dear.
Right.
All right. Where do you want to start? Do you want to start with Warren Buffett or?
Yeah. Let's start with Buffett. So I mean, the letter actually was relatively short. Compared to he usually has I'm right on saying that, I think, right? He usually has a massive letter.
It's usually pretty lengthy. Yeah.
I mean, it wasn't terribly short, but it was kind of it was to the point, I guess, is kind of the key of it. Where do you want to start with this?
Yeah. So there was when I read through it, I just kind of sat down one evening, sitting here looking at the sunset at Glenelg Beach, and I was just reading through the letter. It's quite nice, actually. But I think there was kind of, in my opinion, there were three big kind of points that he focused on. Of course, there's going to be the breakdown of what's going on at Berkshire Hathaway. So there was the Berkshire stuff, the Berkshire specific business kind of stuff. That's all Berkshire specific, I guess, in the Berkshire Hathaway annual letter to shareholders. But then I found he spent quite a bit of time talking about why he holds so much cash, which I found really interesting, which we'll talk about. And then he also spent a big chunk of time talking about share repurchases, because of course he's been doing a lot of Berkshire Hathaway share repurchases lately. So should we start at the top with kind of some of the Berkshire stuff?
Yeah. So I mean, he started off really running through talking about kind of the four key pillars of Berkshire, like the kind of the four biggest parts of his business. So at the top, there's his insurance business, which is mostly wholly owned. So businesses like National Indemnity, Geico. And then his second big pillar was Apple. And he spoke about Apple a little bit, about their ownership, how it's increased slightly due to Apple's aggressive share repurchases. They now own 5.55% of Apple. They then have their railroad business and then their Berkshire Hathaway energy business, which they mostly own. Yeah.
Yeah. I'll just talk through some of the key takeaways I found from each one. So for the insurance business, of course, Warren Buffett, he loves to talk about this. I think he gets very excited when people start talking about insurance float. He loves to explain it every year. So for those that don't know, he was talking about float. Float is essentially the money that Berkshire gets up front for free for all these insurance premiums, because of course people tend to pay them up front, and then it's technically not Berkshire's money, and sometimes they do have to give that money back when there's a claim that's made, and sometimes they have to give back a lot of that money when a lot of claims are made with natural disasters and whatnot. But in the meantime, they're allowed to use that money. And that's the idea of float. It's a very powerful advantage of their insurance business, that they've got all of this money that gets given to them through insurance products, and then they just get to go and make investments with that money and reap the rewards of the investments that they make. So Buffett always likes to talk about good old insurance float. Then Apple, you're exactly right. He spoke about the ownership percentage. So they own 5.55% of Apple. That's up from 5.39%. And he spoke that he told us that that's just from share repurchases. Like, Warren Buffett has had to do absolutely nothing to get that increase in percentage ownership. And he actually, one quote that I took out of it, out of the letter, is he said, "That sounds like small potatoes, but consider that 0.1% of Apple's 2021 earnings amounted to $100 million. So
that's insane. It's crazy.
Yeah. It's not chump change here. It's quite a lot of money, even if it's only a slight increase, of like a fraction of a percent increase in ownership. So that was the Apple discussion. And then, of course, he talked about Bnsf, which is their railroad business. So they reported record earnings of $6 billion in 2021. He noted that Bnsf trains traveled 143 million miles in 2021 and carried 535 million tons of cargo, which he notes is an accomplishment that far exceeds any other railroad in America. So that was Bnsf. And then lastly, Berkshire Hathaway Energy. I didn't realize that they own 91.1% of Berkshire Hathaway Energy. For some reason, I never looked into it in depth enough. I didn't know that there was 9-ish% that's owned elsewhere.
Yeah, I didn't know that either. Yeah, that's really interesting. And it was interesting to see, and he's done this with a couple of letters over the past couple of years, but it seems to have ramped up. He spends quite a lot of time kind of justifying or explaining, I guess, kind of the environmental impact of some of their businesses. And I wonder if this is kind of, I wonder if this is his personal opinion on the topic, or whether it's a reaction to some of the criticism that people have had of him investing in businesses, like investing in oil businesses and that sort of thing. I know there's been a lot of criticism, and I wonder if this is kind of a reaction to that, or whether that's kind of his position, because Charlie Munger is definitely... I think if Charlie Munger was writing this letter, he probably wouldn't have included some of those things, especially with what he said at the Daily Journal meeting, which was, he essentially said he would be extremely surprised if climate change turned out to be as bad as it is, as people are suggesting it will be. So it was kind of interesting to see that. I don't know.
He spoke. He referenced a lot how they're trying to tackle kind of climate change and switching to renewables, and how he referenced Greg's letter, which apparently goes into much more detail about the climate kind of policies and that sort of thing, which was very interesting. He noted that Berkshire Hathaway Energy earned $4 billion in 2021, this was interesting, up more than 30-fold from the 122 million in 2000, which was the year that Berkshire purchased their stake. So over time, that's a pretty solid business, I would say.
Yeah, pretty good. Not too bad. Was 30-fold.
122 million in earnings up to 4 billion. But you're right. It's difficult. I mean, going back to what you're saying, it's difficult for Buffett to please everybody, of course, because of course they're an energy company. So the number one thing they need to do is provide energy to people. And traditionally we have had all of the, all of our energy has been derived from the consumption of fossil fuels. So it's very difficult for a business that, is their number one goal is to make sure people can switch the lights on. But at the same time, they've got now, of course, because it's such an issue, and I'm definitely in that camp of we need to transition to renewables ASAP. Yeah. But it must be very hard for these businesses to say, look, I know that a lot of our assets are still fossil fuel based, but we are making the transition. Trust us, we are doing it. It's just a massive, massive task for them to actually get all of their assets renewable. Yeah, 100%. So it's just a difficult thing where you've got to run your business. A lot of your business assets are not renewable, but I think the main thing is that they are genuinely interested in making the switch over. And I definitely believe that Berkshire Hathaway Energy are very much interested and continue to strive to create more and more renewable assets and become less and less reliant on fossil fuels to generate energy. Yeah. And on your point about earnings, he, of course, throughout the letter, of course, he's talking about the profits and earnings of all of the different businesses within Berkshire Hathaway. And then about halfway down, this is what he said. He said, and also we're talking about the old-fashioned sort of earnings that we favor, a figure calculated after interest, taxes, and depreciation, amortization, and all forms of compensation, which is a nice kind of polite way of taking a shot at Wall Street, who now primarily focus on a figure called Ebitda, which is earnings before interest, tax, depreciation, and amortization, which is, it's interesting to kind of see him get that dig in there because, Ebitda is an industry standard, and it really is, isn't it? And he described it as deceptive adjustments, which it really is, because it's excluding some key expenses, some key costs for the business. Exactly. Tax, interest, they're real expenses. They don't, you can't not pay taxes, although some businesses try their best. Well, I mean, I guess some businesses succeed, but I mean, it's true. Most of them have to pay taxes. Let's just say that. But even depreciation and amortization, they're not real cash charges. They're not money actually being outlaid by the business, but they reflect the fact that the business does need to spend money on capital expenditure. They need to continue to repair and replace machinery and buildings and property over time. So these are real expenses. And I think the fact that Ebitda is such an industry standard, and that most businesses even, because it's an industry standard, as a reaction to that, most businesses report Ebitda as kind of the headline number, or EBIT, which is earnings before interest and tax at least. Yeah.
because it's an industry standard, most businesses kind of use it, and it's kind of a reminder that irrational behavior isn't limited to the retail investor world, which is something that I think Wall Street and financial institutions often like you to think that they're the experts, they know what they're doing, and that you're the trust us. You're the silly retail investor. You don't understand. When the reality is, they like to use Ebitda because it is often, it's always bigger than the net income figure. So it's just a money-driven decision. It's not based in rationale of understanding and finding the value of the underlying business. So I thought that was an interesting point, an interesting lesson that Buffett was able to sneak in there.
And I think you, as a shareholder, you don't want them to leave these things out. Like,
no.
You as a shareholder, you want to, you're the one that flippin' owns the shares of this business. You want to know the facts. You want to know the reality. You want to know the earnings after everything. Oh, don't leave this, that, and the other out, because this, that, and the other is not left out in reality. You still have to pay taxes.
Yeah.
So I think, as a shareholder, you want to know the absolute, like, what, just tell me what's going on. Tell me the reality of this situation. Because if you wanted to then go, okay, but I just want to look at purely what the business operations are doing, then you can still do that. You've got operating income. So
yeah.
I don't know.
It's kind of like an individual. It's like kind of like a person bragging to their friends, how much money they had at the end of the day, but they exclude, their massive credit card debts or something. And then when they go home after hanging out with their friends, they look in the bank account and it's negative. That's really what it's like.
It's like when you see those ads on YouTube from those people pushing like Amazon FBA e-commerce scams, where they're like, look, we just did $1 million in revenue. And it's like, yeah, but that's revenue. Like, what's your profit? Your profit's probably, squat, because you don't reference profit. You've probably got $1 million in revenue, but you probably got almost equal as amount of expenses. So your profit's probably nothing.
Yeah, actually, we spent $1.001 million on advertising, but no, it's
exactly.
Yeah, it's just deceptive. So no, it's always refreshing to see Buffett give us those little reminders or nuggets of kind of core investing principles, because there can be a lot of like little things like that are important to understand. And
absolutely,
if you just go through the annual letters, you always get like these little reminders and these little nuggets of knowledge that are really valuable. But from there, I don't know. Where do you want to go from there?
I was just going to say, so that was kind of their first. That was all the Berkshire stuff they were talking about, I guess. Their different businesses. I did want to talk about what Buffett said regarding his cash position, because if you don't know, Berkshire has about I guess it says it right here. They've got 144 billion of cash and cash equivalents, which is pretty insane.
Yep.
I think it puts them at about 20 to 30% cash when you include their stock portfolio, but it's a lot. And of course, this is not something that Warren Buffett looks to do. He doesn't want to hold that amount of cash, but I thought it was interesting that in this letter, he actually took the time to go through and talk about exactly what's going on. So I wanted to read you. Can I read you this excerpt? It is quite long, but this is what he said about holding holding the amount of cash he does. He says, Berkshire's balance sheet includes 144 billion of cash and cash equivalents, excluding the holdings of BNSF and BHE. Of this sum, 120 billion is held in US Treasury bills, all maturing in less than a year. That stake leaves Berkshire financing about 0.5% of the publicly held national debt.
That's crazy.
How crazy is that?
Yeah, that's an insane amount. I had to highlight that in the doc because it's just that's just incredible. This seems like such a strange statistic. Yeah, 1% of the government's publicly held debt is on our balance sheet. It's crazy.
Yeah. It is pretty insane. He says, Charlie and I have pledged that Berkshire, along with our subsidiaries other than BNSF and BHE, will always hold more than 30 billion of cash and cash equivalents. We want your company to be financially impregnable and never dependent on the kindness of strangers or even that of friends. Both of us like to sleep soundly, and we want our creditors, insurance claimants, and you to do so as well. But 144 billion? That imposing sum, I assure you, is not some deranged expression of patriotism, nor have Charlie and I lost our overwhelming preference for business ownership. Indeed, I first manifested my enthusiasm for that 80 years ago on March 11, 1942, when I purchased 3 shares of City Services preferred stock. Their cost was $114.75 per share and required all of my savings. Quote, and then he puts in brackets, the Dow Jones Industrial Average that day closed at 99. A fact that should scream to you, never bet against America. That's pretty insane.
That is pretty funny. 2 digits. What's it now? Like 10, 20,000 or something like that? I don't know. It's
over 20,000, I think, the Dow. I don't know. I don't track the Dow, but I think it's like 24,000?
34,000.
So he said? 34,000. Sorry, my mistake.
There you go.
But yeah. There you go. He says, after my initial plunge, I always kept at least 80% of my net worth in equities. My favored status throughout that period was 100% and still is. Berkshire's current 80% or so position in businesses is a consequence of my failure to find entire companies or small portions thereof, that is marketable stocks, which meet our criteria for long-term holding. Charlie and I have endured similar cash-heavy positions from time to time in the past. These periods are never pleasant. They are also never permanent. And fortunately, we have a mildly attractive alternative during 2020-2021 for deploying capital, which we'll talk about in a second. But it's interesting. I guess Buffett is just saying, look, guys, we know we've got a lot of cash. We know we've got more cash on our books than what we need. However, this is why. We want to be all in, but we just can't do it. But it's interesting that even Warren Buffett, he's the kind of manager that's never going to shift blame. So even though he could have just said, look, guys, the market is just insanely hot. There aren't any good opportunities to buy. Instead, he says, I have failed to find any opportunities. It's just interesting how he always puts it back on himself, a sign of a good manager.
Yeah, it is interesting. And it's certainly for Berkshire a combination of size, so inability to find good investment opportunities where they can put enough of that 144 billion to work for it to be a significant piece of their business and not split that up into 100 different companies that they can't keep track of. So that's, certainly part of it. And then I think also just, where the market is at the moment, certainly plays a role. But yeah, it is interesting to hear him kind of talk about it from that perspective. Before we get into the alternative that Berkshire is doing instead of investing, or looking for new equities really at the moment, let's talk about some of their equity investments, and then we'll circle back to that.
But sure. Yeah.
At the moment they have, so these are just, pieces of businesses, not their wholly owned businesses, but they have $350 billion in market value in their equity investments, and these are accounted for on the balance sheet by market value. So this was a fairly recent accounting change, actually, where now it's accounted for on the balance sheet by market value, and on the income statement, changes in market value is included as profit or loss, which over the long term relatively makes sense, but in the short term can be incredibly volatile. If a stock goes down in the short term, even if the value of the stock hasn't gone down, it'll affect their Berkshire's earnings. So that's kind of a consequence of a change that I think came in the last couple of years. But interestingly, they haven't made any changes, as Buffett kind of alluded to, but major changes, I should say. And 72% of those equity assets are concentrated in 4 positions: Apple, American Express, Bank of America, and Coca-Cola. Which all together represent about 250 billion of the 350 billion or something like that. So very
pretty top-heavy portfolio, isn't it?
Yeah, exactly right. Very, very concentrated, and no changes to the top there at all. He hasn't added to any of those positions, as far as I'm aware, in a very long time. But of course, he gets kind of the increased ownership, as we spoke about, of Apple through share repurchases. He also owns 26.6% of Kraft Heinz and 38.6% of Pilot Corporation. And because he owns a large percentage of these, they actually don't get counted on the balance sheet by market value, even though they're public companies. Just the share of equity is counted on the balance sheet. And the accounting rule for that is basically when an ownership drives significant influence, is the quote, over the business,
right,
then you include it in the equity on the balance sheet rather than the market value. So that's kind of a couple of positions that you don't kind of see or accounted for in a different way. But yeah, that's the equity portfolio, and it hasn't really changed for the most part. I mean, we talk about every quarter, we look at the 13F, and there's some little changes here and there, but there's been really nothing major that's affected, the top, let's say 70% of the portfolio. So interesting.
And it's interesting when he listed those big, the biggest positions in his portfolio. I always forget because with Berkshire Hathaway, I'm always looking at 13Fs. But of course, we've got some of those big international positions as well in there, which I don't know why. It just slips my brain. But of course, their equity portfolio is not just in the US. But yeah, definitely interesting. If you wanted to go and have a look at, Warren Buffett talking about the top positions in his, equities portfolio, then definitely go and check out the letter because it was very interesting. But then we do get onto share repurchases. So again, I'll just read you what he said about the Berkshire Hathaway share repurchases that he's been doing. As he hasn't been finding great opportunities to put money into different businesses out there. So one option, of course, is to put money back into his own business, but not through internal reinvestment, but through just buying back the shares. So this is what he says. He says, there are three ways that we can increase the value of your investment. The first is always front and center in our minds. It's increase the long-term earning power of Berkshire's controlled businesses through internal growth or by making acquisitions. Today, internal opportunities deliver far better returns than acquisitions. The size of those opportunities, however, is small compared to Berkshire's resources. Our second choice is to buy non-controlling part interests in the many good or great businesses that are publicly traded. From time to time, such possibilities are both numerous and blatantly attractive. Today, though, we find little that excites us. That's largely because of a truism. Long-term interest rates that are low push the prices of all productive investments upward, whether these are stocks, apartments, farms, oil wells, or whatever. Other factors influence valuations as well, but interest rates will always be important. Our final path to value creation is to repurchase Berkshire shares. Through that simple act, we increase your share of the many controlled and non-controlled businesses Berkshire owns. When the price/value equation is right, this path is the easiest and most certain way for us to increase your wealth. Alongside the accretion of value to continuing shareholders, a couple of other parties gain. Repurchases are modestly beneficial to the seller of the repurchase shares and to society as well. Periodically, as alternative paths become unattractive, repurchases make good sense for Berkshire owners. During the past 2 years, we therefore repurchased 9% of the shares that were outstanding at year-end 2019 for a total cost of $51.7 billion. That expenditure left our continuing shareholders owning about 10% more of all Berkshire businesses, whether those are wholly owned, such as Bnsf or Geico, or partly owned, such as Coca-Cola and Moody's. I want to underscore that for Berkshire repurchases to make sense, our shares must offer appropriate value. We don't want to overpay for the shares of other companies, and it would be value destroying if we were to overpay when we are buying Berkshire. As of February 23, 2022, since year-end, we repurchased additional shares at a cost of $1.2 billion. Our appetite remains large, but will always remain price-dependent. So, sorry about that being so goddamn long.
No, it's
but I found it very interesting that he's clearly saying that we're not going to be silly, we're not going to just throw away money in terms of our share repurchases. But if we got no other options and our shares are cheap, we're going to do that because it does benefit shareholders quite a lot.
Yeah, exactly. If shares can be bought below what they're worth, and in other words, if they can outlay less money when repurchasing stock than what Berkshire will produce in the future, then that equation makes sense. And I think something important kind of to note here is they're not piling all of their cash into share repurchases. So I think share repurchasing has become the best way to deliver cash to shareholders for Berkshire and for other companies, with valuations with where they are and interest rates with where they are. But they're still not going to be getting the returns that they would love to get if they could buy an individual business at a really low price. So they're not piling huge amounts of money into share repurchases. They're doing a lot, but they're still sitting on quite a lot of cash. And still looking to deploy that into some other investment opportunities.
Yeah. Imagine if they just came out and Buffett puts like, I don't know, $100 billion to share repurchases. Yeah. That would just be the biggest story. But no, you're right. You wouldn't want to spend all of your money. I mean, as you said, it's not their most ideal way of deploying their cash. But I mean, when the other two options aren't really there, then, the third will come through. So, yeah. And, I mean, it makes sense. It still helps out shareholders. But there you go. So I think those were the three main takeaways that I got out of the letter, the kind of Buffett talking about the 4 key pillars of Berkshire, and then him talking about his cash position and him talking about share repurchases. Was there anything you wanted to talk about? Anything else you took out of the letter? Yeah,
I just had one other thing. This was towards the end, and this kind of closes out the letter. Buffett spoke about something Charlie Munger calls the Orangutan Effect, which I thought was really, really interesting. He was talking about how he'd been teaching for, I think he said 70 years, and he's finally kind of stopped doing it in 2018, where he would go around to universities and to schools and kind of provide some investment education through that means. And he spoke about how teaching has been a great way for him to clarify his own thoughts. And Charlie Munger calls this the orangutan effect. And this is the quote: "If you sit down with an orangutan and carefully explain it one of your cherished ideas, you may leave behind a puzzled primate, but you yourself will exit thinking more clearly." So basically saying that, teaching has this double effect. Of course, you can provide value to people, but regardless of that effect, being able to express your ideas either to other people, or if you can express them in writing, I think he spoke about as well, allows you to think more clearly. And I think this probably resonates with you as well, but it resonated with me significantly because we both spend a lot of time doing this in a way.
Absolutely.
Creating YouTube content, we're writing scripts, we're talking to a camera, maybe not to an audience most of the time, like directly, but we're essentially explaining these investment ideas over and over and over again, and coming up with ways to explain them in easy to digest ways for an audience. And that in of itself, going over and over and over again, that repetition of investing principles and digging into companies definitely helps you think clearer and get your ideas in order. I don't know. Does that resonate with you as well?
Yeah, absolutely. I mean, it kind of goes back to what all the top dog value investors say. It's just like, yeah, you can do all this research, but then go and explain it to a 5-year-old, explain your investment thesis to a 5-year-old. And if you can do that, then you'll have a pretty good grip on the company. You know what you're talking about. But yeah, I absolutely think that. And I recognize this effect even going back to when I was in high school and college. I used to sit chemistry and physics tests, and my mum's a science teacher. So whenever I didn't know or understand a concept at school, and my friends that were sitting alongside me also didn't understand, I would go home, have my mum explain it to me, and then whether, a good test of whether I knew it for the test is whether I could take what my mum explained to me and then I could go and explain it to my friends. And I always knew that if I could go and explain it to my friends and my friends understood it, then I knew that I knew what I was talking about for the test. So that it's really interesting, something that I've always I've done as well. And I think it is very, very valuable. If you can teach someone else, then it tells you that you yourself understand what you're talking about. But yeah, absolutely. Very interesting.
All right.
So I think that was all. One thing I just wanted to add is that I always try and go through and find like a favorite quote of each letter, because every year we read these letters every year, for those that don't know. And I definitely encourage you as well to go and do it, because people sometimes say, like to Buffett, hey, why don't you, put all your investing thoughts down into a book? Why don't you create a course that people can go and do? And he's like, well, actually, I do that already, but you just don't understand that it's an ongoing book. And what he means by that is that every year he comes back and he adds another chapter to his book, which is the Berkshire Hathaway annual shareholder letters. So my favorite quote anyway that I took out of this thing was, our goal is to have meaningful investments in businesses with both durable economic advantages and a first-class CEO. Please note particularly that we own stocks based on our expectations about their long-term business performance and not because we view them as vehicles for timely market moves. That point is crucial. Charlie and I are not stock pickers, we are business pickers. And for most of us, we probably already know that. I mean, it makes sense, especially if you keep up to date with these guys, but it's nice just to hear it from the horse's mouth again that, moat management, and always look at the business and don't worry about time in the market or trying to pick stocks, pick businesses instead. Anyway, I like that one.
Yeah. I think that was probably my favorite quote from it as well. It's just kind of a nice summary that Buffett always puts in his letter of what they're trying to do when they're looking for investments.
Yeah, exactly.
Which is find a great company run by great people, buy it at an appropriate price. Although I didn't really, I guess, include that last bit in there.
Yeah, he didn't. Yeah.
I think it's always refreshing to have those kind of those reminders in there. All right, should we talk about the Russian stock market, because that's been going through it over the past couple of weeks. There's a number of things kind of going on within it that I kind of wanted to talk about, and a couple of just insane statistics as well of what's going on. So the Russian stock market erased 2 years of growth in 2 days last week. 2 years of growth in 2 days, which is kind of insane.
Bang.
That's painful.
Brutal.
Yeah. So the MSCI Russia Index, which is a US index, it's listed on the New York Stock Exchange, but it tracks Russian companies, is down 77% from its October 2021 high. So the market actually set highs well before all of what's going on now begun. But of course, the collapse was accelerated significantly by the developments over the past couple of weeks. The market fell 33% in a single day on Tuesday. This was already after the 2 years of gains had been erased the previous week. So, it's in quite a bit of trouble, and all of this is actually happening while the Russian stock market remains closed. So trading stocks on the Russian stock market you can't do that currently. But this US ETF that tracks Russian stocks remains open and continues to trade, and that's what we're able to track. So even though you can't actually directly on the Russian stock market trade these businesses, you can still buy and sell the ETF, which is basically a derivative on those Russian shares. On Tuesday, BlackRock, which runs the iShares family of ETFs, issued a notice to investors announcing its suspension of the creation of new shares in the fund. And they said the liquidity of Russian securities and its currency has experienced significant declines. In the light of these circumstances, iShares Russia ETF has temporarily suspended the creation of new shares until further notice. BlackRock cautions investors on the index that the index may not meet its objective, may experience increased tracking error, may experience significant premiums or discounts to the net asset value, and or have bid-ask spreads that are wider than historical average. So essentially, you can still trade the shares. They're not going to be creating new shares, which often happens when the net asset value increases. But they've also warned that the results of the ETF might not actually meet the investment objective, which in the case of an ETF, in case of an index, is to mimic the returns of those shares. Really interesting. It was kind of strange to me to think that you can still trade the Russian ETF, even though, say, BlackRock can't directly buy the shares on the primary market. They're only able to buy shares on secondary markets. And you would think that if the official market is closed, that the ETF should halt as well. I don't know.
Also be closed. Yeah.
That's what I would have thought, but not the case. So you can still trade it if you want, but it's getting hurt significantly. Investment capital is just flying out of Russia. And as a result of that, the Russian currency, rubles, I think is how it's pronounced, is also in free fall. So the Russian currency is down over 30%, which is a massive fall in a currency, which is, it's kind of the same thing as describing in inflation, right? It's the currency losing purchasing power. And that has a real effect on people. So the central bank in reaction to this has been raising interest rates. So they raised interest rates from 9.5% up to 20%. And why they do that is to try and attract investors in that currency, right? So if, they increase the interest rate to 20%, people with US dollars might think, hey, I can get a pretty good return there. Obviously, you need to account for inflation and the devaluing of the currency, but maybe I'll put my money there, and that kind of drives demand in the currency, or at least they're hoping. It's raising interest rates, given everything that's going on with already a lot of businesses pulling out of Russia and their economy hurting. Raising interest rates is not exactly the greatest thing they can do. It's certainly going to encourage and accelerate the struggle that's going on.
Yeah, and this is the thing that just makes me a little bit sad because, I think I read something on Twitter which is just like everybody's saying how much they hate Russia, and it's like don't hate Russia, hate their leadership. Because unfortunately, and this is the way it is that you see the protests that are happening in Russia that say, the Russian citizens are saying, we don't want this war. Like we don't want, like they treat, they were saying that, people of the Ukraine, their Ukrainian brothers and sisters, they were calling them, they're close. And a lot of people don't want what is happening. So I really feel for obviously the people of the Ukraine, the Ukrainians out there, but also some of the citizens of Russia, because now that the Russian leadership has decided to invade and have, said, no, we're doing it, fire those rockets, baby, let's go. Yeah. Then unfortunately, all of these economic sanctions and these restrictions that are being put on Russia, which are trying to choke Russia's economy, the reason that we're doing that, or the countries around the world are doing that, is to try and choke the Russian war effort and to make Putin realize that actually, holy smokes, we're getting decimated through economic means, but the people that have to bear the brunt of that are the Russian citizens. Yeah. So they're copping their currency falling in value. They're copping these massively raised interest rates. And it's because of what all of the external countries are inflicting on Russia. But the reason that the external countries are inflicting this economic pain on Russia is to try and stop them from going, to war with the Ukraine. But it's just, I just don't like, it's just nobody wins. Nobody wins. Yeah. And I think that's what's frustrating me so much, is that I feel for people on all sides, It's just not a great situation. But yeah, no doubt that the Russian economy is getting choked, and that's been the target. That's what the US and members of the EU, the European countries have been trying to do, and it's working. I read something that JP Morgan was predicting the Russian economy is going to shrink 35%.
Wow,
which is pretty insane.
That's crazy.
The Wall Street firm expects Russia's gross domestic product to contract by 35% in the second quarter of 2022 and 7% for the full year. A dramatic slowdown comparable to the financial crises of 1998 and 2008. So, it's just so sad, and it's very sad that we're in this situation.
Yeah.
But dear oh dear.
Yeah.
And I don't want to sound like I'm some sort of expert in economic policy or foreign policy or
No. Yeah.
I really am just a citizen of Australia that is seeing what's happening in the world and is saddened by it. That's really all I can say. I'm not some expert on this sort of stuff. But yeah, they're certainly targeting Russia's economy, aren't they?
Yeah. It's obviously incredibly sad to see, and we've kind of restrained ourselves from talking about it just because it's so complex and it's not an area that either of us understand very well. So it kind of, I don't think it wouldn't be really our place to try and talk more about what's going on. But I thought we could kind of talk briefly about what's happening in the Russian stock market.
But the economic consequences are severe.
Yeah, exactly right. All right, I had just one other thing I wanted to talk about, which is Foot Locker.
Yes.
Foot Locker stock is down 30%, as I mentioned, this week. Massive drop after Foot Locker announced a reduced relationship with Nike.
Okay.
I'll talk a little bit about why this matters so much for Foot Locker. So just to give you some numbers out of their earnings, first of all, they reported their Q4 2021 earnings and their full year results, of course. Revenue for the full year 2021 came in at $8.9 billion, which was up 18.7% year over year, which is massive for a retailer like Foot Locker that's grown historically at over the last decade at about 4, 5, 6%, something like that. So they're a fairly mature business, fairly slow growth, but with the coming off the back of 2020. Which was a massive slowdown for these physical retailers. They've seen quite considerable growth. Comparable store sales growth was the biggest driver of revenue, which was up 15.4%, which is massive. And then they continued to expand their store network. Net income came in at $893 million, which was up 179.5%. So massive. And that's less of a reflection of a high net income number, although it is high, but more of a reflection of the fact that in 2020 it was so low. Because these physical retailers, even if there's a fairly small drop in revenue, because they're not high margin, it usually results in a dramatic contraction of net income, especially because a lot of their costs can't really be reduced as the revenue goes down. So that's going on with their business. So in terms of the quarter and the year, they actually performed very, very well. But the big news was around their relationship going forward with Nike. So Nike historically has been a huge supplier for Foot Locker. They actually represented 75% of Foot Locker's sales in 2020 and 70% in 2021. So the vast majority of sales are Nike, which makes sense. Nike
is so reliant on Nike.
Yeah, it's massive. I mean, even if a company is 20, 30% reliant on one vendor or one client, that's a big deal. 75% is huge exposure to one company. And in the press release, they announced that this is expected to drop to 55% of total sales by Q4 2022. And the quote is, this reflects the accelerated strategic shift to direct to consumer by one of the company's vendors. So they didn't actually mention Nike, which is kind of funny.
I wonder who.
I don't know if that's a legal thing that they're not allowed to disclose that but everyone can just assume it. I really don't know. It must be a legal thing because everyone knows that it is Nike. So I'm not sure, but if that,
it must be that Nike has some sort of strategic plan that they need to announce to market, but they haven't announced it yet. So because that's normally what happens when they say, oh, one of our strategic partners is considering this. When they don't name it, it just means that the other party need to announce something, but they haven't done so yet.
Yeah.
So potentially they were waiting for Nike to say, look, this is a change in our strategy, more direct to consumer, but because they hadn't said it yet, they couldn't name them.
Yeah.
Maybe that was what it was.
Yeah, it is just funny because the way they phrased it, but everybody knows that it's Nike because only Nike could result in that kind of drop in the percentage of well, I mean, they described that the largest vendor would be shrinking, and we know that the largest vendor is Nike. So, but they basically said Nike is going to be focusing on selling more directly to consumers rather than through retailers like Foot Locker. And even though this change is going to begin in Q4 of 2022, so a year away, Foot Locker is projecting -8% to -10% comparable store sales growth for the full year. So even though this change is starting, there's going to be 3 quarters where the relationship continues, and then the 4th quarter is where the change will happen. And then for the full year, they're expecting a 10% drop in sales. So this is a massive change. It's not really surprising that the stock fell 30% on the news because that's terrifying. Imagine what the guidance would be if this change was happening for the full year. I don't know what that's going to look like, but it's going to be substantial. Although to be fair, the 4th quarter is always about half the sales of these businesses because it's Christmas time, a holiday period. But in response, Foot Locker said they'll be launching more of their own private label brands, which good luck with that.
You're going to have to.
That's all I'll say.
Good luck.
Yeah, I mean, I think this just reflects the risk of retailers who rely on the brand name of other companies, especially if it's very, very concentrated like it was with Foot Locker and Nike. And this problem, I think, is one dramatic example of what we're going to see more and more of as retail moves online. Because the advantage that Foot Locker has had for so long is they have these physical locations where there's a lot of foot traffic and where consumers are primarily purchasing products through retail at physical locations. So brands want to be in front of that traffic, right? But as more of that retail traffic moves online, and retail, essentially the retail real estate, if you think of it like that, moves to this digital landscape, then the brick and mortar chains will essentially lose the advantage, the one competitive moat that they have, which is where their stores are located and their customers. So, very, very interesting to kind of see. The stock's also down 60% from its all-time highs. So, it's been a tough one.
Yeah, this has probably been, in a similar vein, one of the worst investments that I made back before I knew what the heck I was doing. I probably still don't know what the heck I'm doing now. But back in the day, I just bought shares based on what someone said on YouTube or something about Vita Group. And Vita Group, they operate a lot of Telstra. They have a contract to operate Telstra's retail stores in Australia. And then there was, someone talking it up. Oh, it's super cheap. And anyway, I just bought these shares not knowing what the heck I was doing. And then sure enough, there's an announcement that Telstra are suffering and they're going to not, provide so much business to Vita Group anymore. And that sent the Vita Group shares down a lot. But that taught me a lesson that I will never, it's a mistake I will never repeat. Don't invest in companies that are reliant on another business, because that, if you think about it, that's like the opposite of a competitive advantage. That's a competitive reliance. They rely on something else. But Oh gosh. So that, yeah, when I look at this and you say, oh, look, a store like Foot Locker, oh yeah, Foot Locker's kind of cool. They're trendy. People shop there. And then you might look into the business. Oh, so much of their sales are just Nike. Okay. They have a deal with Nike. Oh, okay. So, what happens if Nike pulls out? Foot Locker goes to absolute, nothing. Then maybe Foot Locker, I would say, does not have a competitive advantage. They would struggle to stand on their own 2 feet if we made this a little shoe reference.
Well done. No, but
that's funny, Brandon. Good one.
Ha ha ha. No, it'll be interesting to see what happens because footwear and these kinds of stores like Foot Locker have always been interesting to me because I would imagine it's one of the last retail stores to transition online. Obviously they'll transition to an extent, but you would have to imagine there's still a significant portion of people who want to go in and try shoes on before they buy them, especially because it's really frustrating if you were to buy shoes online and then they come and then they don't fit, and shoe sizes are all different from brand to brand. But I'm sure there will be, that will still move online over time as everything does. But it is interesting. They are in an interesting position, but yeah, it can't be that heavily reliant on one brand. And it was kind of funny to me to see them say that they were going to start more of their own private label brands. I just don't see that doing well.
Good luck.
Yeah, you're competing against some big brands there. So yeah, good luck to you.
Yeah. So like walk down the street and you could look at or walk through the shopping center and look at everybody's shoes and you'll probably see 4 brands, 5 brands maybe.
No, actually.
That's all you'll see.
It's not true, actually. 9 out of 10 Foot Locker brand shoes. I always see them. They're everywhere. You don't have Foot Locker branded shoes? Yeah. What?
Yeah.
Unbelievable.
Well, I don't even know what Foot Locker branded shoes are.
I don't know. I don't think they do. I don't think they have shoes, right? I don't think so.
Yeah, I don't know. Well, it sounds like they're not called Foot Locker shoes. They're probably called a different brand, but it's a brand that Foot Locker owns. But yeah, I still don't know what it is. So it shows you how big these shoes really are,
Yeah.
But anyway.
All right.
Yeah, so there you go. Very interesting. Yeah. Should we do a couple of Q&A questions before we get out of here?
Yeah, let's squeeze 1 or 2 in. Where should we go?
Should we do this one here?
Yeah. All right. All
right, sure.
Do you want me to read it too?
Yeah, sure. Go for it.
With recent discounted cash flow discussions and recent discussion on Tesla and Netflix, could we hear your intrinsic values that you would mark them with? I task Brandon and Tesla, obviously, and Hamish with Netflix. Thanks as always for the content.
Yeah, thanks for the question. Well, I won't go into the actual numbers of discounted cash flow intrinsic values, and I don't do that because as soon as you say these sort of numbers, people start clinging to them. Even if we say don't cling to them, people do cling to them. But the way that maybe we can talk about the way that we would go through a valuation of a Netflix or of a Tesla. I'll start with Tesla. So Tesla's pretty interesting because every business is different. So the way you have to approach different businesses it will just be completely different. So with Tesla, and you could probably ask 10 different people that are invested in Tesla and they give you 10 different answers. But the way that I would tend to go about it is there's Tesla as it exists now and their current business operations and how their business is going right now. And then there's a series of future bets, things that aren't really providing a lot of revenue or profit for Tesla now, but there's the potential of future profit at some point. And in some instances, there's a lot of future profit at some point. But I think the value investor, the low risk, intelligent investor would stay conservative. And if you're looking at a company like Tesla, you would start by running a discounted cash flow model purely based on what they have already established. So pretty much all of their current business is just making cars, selling cars. make profit. So I think what you would do is you would go and you would have a look at, okay, what are they currently producing? What are their margins like? How many cars are they making? And that, if you start looking at those stats which are reported already, you can start to get a fairly good understanding of what their future financials will be in the near term from their automotive business. You can look at what is the unit production going to be from Giga Berlin and Giga Texas when they come online this year. What are their unit production looking like already? How much, what are their margins like? How's their cash flow at the moment? How's that going to grow? You can start to look at that. And then you get to this. So that's the first part. Then you get to this second part of the business, which is like all the future stuff. So like full self-driving, massive expansion of Tesla energy, all of those kind of the Tesla bot, for example, all those future projects that just have big question marks. And what I see a lot of people do is that they are already modeling like, oh, the Tesla bot's going to sell 1.5 million units per year by 2025, blah, blah, blah. And it's going to lead to that. I think that's a little bit dangerous because there's just not, those businesses basically don't exist yet. You can model, but full self-driving is going to be worth this much and it's going to be done by this time and it's going to bring in this much money. I think it's dangerous if you do that because you just don't know. So I think there's an element of, yes, there will be future revenue, but I think the conservative investor would just look at kind of where they are now and how their fundamental business, which is making cars and selling cars, how is that going to grow over time? How can you model that and keep it conservative so that you're not placing a massive bet on something that really hasn't occurred yet. Does that?
Yeah.
Is that a fair way of going about Tesla?
Nah, that's excellent. It's great. Yeah, and I'll do the same thing for Netflix. I'm obviously not going to go through specific numbers, but I can talk about how I would approach it. And I think Netflix, for how you would approach it and just at a top level, is fairly easy to explain, but difficult, I think, to execute. But the first thing I would do is segment the business into regions. So you could segment them into like North America, Europe, and Asia are probably the three key regions. And they provide their breakdown for those as well. And each segment or each region needs a projection of two things. One is the number of subscribers you think they can achieve, or a range of that, and a projection of revenue per subscriber. And you really need to segment it into different regions because each region is going to be massively different in terms of how much revenue per subscriber they can get, what's reasonable, and the number of subscribers. So India and North America, comparing those two is a really good example. In North America, they currently generate about $10 per month per subscriber. In India, I think it's about $3. And that's because cable TV is a lot cheaper there, so they have to be competitive there. But then on the number of subs, it's the complete opposite. The total number of potential kind of like, I guess, old cable TV subscribers that could become Netflix subscribers is maybe like 100 million in the US, 120 million. In India, they have 900 million people with access to the internet. So the numbers are different depending on different regions. So that's how I would segment it. And that's where you can kind of get to an idea of what revenue could be. You then will need, essentially beyond that, it's really just an estimation of how much will they need to spend on content in order to maintain that larger and broader subscriber group. So, if they have 100 million subscribers in India or 200 million subscribers in India, they obviously need to be producing more content than they are now because they're not producing that much Indian content, localized Indian content. So that's where your assessment will be. At the moment, they have 220 million subs and they spend 17 billion per year on content. So how will the relationship of those two change over time? Will they need to spend more per sub in 10 years or less per sub in 10 years? And that's kind of the economics that you can think about. Understanding that at a top level, I think, is easy. What's difficult is then going into the nitty gritty of what is reasonable in terms of content spend versus subs and number of subscribers that they can capture across different localized regions.
Nice. I like it. Yep. It makes sense. It's a very logical way to kind of step through. It's I think a lot of, this is something that you've highlighted. This is something that I guess a lot of value investors are looking at is about that content spend, because you're right. There are situations where if they need to spend a lot on content going into the future, then maybe it's very expensive. But maybe if there's a critical value, then maybe it's not so expensive. But
yeah,
did you make a video on Netflix recently on your channel about valuing Netflix? I think you did, didn't you?
Yeah, I did. It was probably 3 or 4 or 5 videos back, but yeah, I did. A really interesting business. I'm actually invested in Netflix now. As of last week.
Oh, are you? Nice.
Not to a huge extent, but it's it's a relatively small position.
Enough to make you pay attention.
Exactly. So yeah, I'm obviously very excited about Netflix's business over the long term. But yeah, you can hear a little bit more about it in that video if you want to check it out on my channel. But yeah, we'll wrap it up there for today. We've been going for, I think, over an hour, close to, not quite sure. We had a little bit of a pause in the middle. So
we've had. Unfortunately, hopefully you guys won't hear this when you listen back to the podcast, but we have had some technical difficulties today trying to record this podcast because I'm sitting here. This is the thing, right? I'll just explain it to all you guys. I'm sitting here and then first of all, I don't know what it was. It's either my microphone conks out or the internet conks out and we lost our connection halfway through recording this, or not even halfway through. And then I'm trying to record. I'm not quite sure how my audio is going to sound because I've got my really good microphone with me today and I'm recording on Adobe Audition, which is the program we always use to record on, and it's saying that the input is definitely my microphone, which should sound super crispy, but when I play it back it just isn't sounding very crispy. So I'm not quite sure what's going on. Then there was a whole raft of issues with inputs and outputs that my computer wasn't recognizing. It was just a flipping mess.
Yeah, you guys just hear the finished.
But hopefully,
yeah, you just hear the finished product. Andrew does an amazing job of patching all our mistakes and stuff together. Yeah. And putting when we're creating these podcasts, it's just what's not working? Oh, okay, we're gonna fix that.
Fix that, fix this. And we've got it to a system when normally we're pretty good.
Normally it's great.
We get to situations like today where things just fall apart. We're not quite sure. But anyway, hopefully, fingers crossed, this still sounds listenable and relatively free of major errors. Oh dear. But with that said, I think we should pretty much wrap things up. Thanks, guys, as always, for listening. I know I say it every week, but I do mean it. Thank you very much for the time that you spend listening to the podcast. We appreciate the support, and we hope that you get something out of it as well. We hope it's quite entertaining and mildly informative. But anyway, thanks guys for listening. Of course, if you wanted to ask a question for next week's podcast, just go over to the YouTube version of the podcast. Just type in Young Investors Podcast, find the most recent podcast episode, leave us a comment, and then we'll take it over into our Google Doc and we add it to the long line of questions. Actually, we're getting through some of them. If you want to ask a question, head over there. It might show up in the next few episodes, actually. But with that said, guys, thank you very much for listening. Thanks, Hamish, as always, for joining me. Thanks to Sharesight for sponsoring. Jeez, I almost stumbled over that. And we'll see you guys in the next video.
See you guys.
In the next episode. Damn it. Bye. All right. Goodbye. Bye-bye. All right. See ya.